so beautifully. I enjoyed every note, every phrase of the release.
Welcome, sir. We start. Your
Economics Conclave. Yesterday, we had very interesting sessions on the impact of COVID 19 on businesses and the economy. Today, also, we have with us eminent speakers who will deliberate further on the issue. Let us start today's session now. May I invite Sri Arijit Basu, MD of Commercial Clients Group and IT Vertical at SBI, to welcome our esteemed guests and set the tone for today. Over to you, sir.
Thank you, Sambhavi, and a very good morning to all who have joined in for the second day of the 7th SBI Banking and Economics Conclave. I take special pleasure in welcoming the Governor of the Reserve Bank of India, Sri Shaktikanta Das, who has very kindly consented to be with us today and deliver his keynote address. Yesterday, it was really heartwarming that the two sessions were very widely attended. This is a very new economics conclave that we are having in an era of COVID where we are doing it digitally, but almost 2,000 people had logged in to listen to two panels. One was, of course, the eminent industry captains, along with our eminent expert from AIMS, Dr. Randeep Guleria, who debated on how COVID has really impacted India and what would be the way forward. I think there were divergent views, but at the end, everyone said that things have started looking up from June onward, and going forward, possibly there will be either a V-shaped recovery or a U-shaped recovery. That was a debate. But things have started looking up in various sectors of the economy, especially in the rural areas. This session was followed by a very, very engrossing and engaging talk by Professor Dani Rodri. He is the John F. Kennedy a professor in the Harvard University, and he spoke at length on how he viewed the global economic challenges, as also at the end what it means for India and how India can take this forward. As far as the global economy was concerned, Professor Roderick spoke of how, in his terms, hyper globalization has taken the world into a completely different direction from what it was when Bretton Woods had come, and why that may not be the right solution. And he was talking about rebalancing the global economy. As far as India is concerned, he said that the reason why India had done very well in the recent past was that it was led by trade related technical areas where India had done very well between 1995 and say 2015. But slowly, I think that period is coming to an end, and India needs to focus on other areas where and how to focus on other areas which would enable us to come back on that growth path. He warned India of short-term financial flows affecting the Indian system. And he also said that inequality is something that we need to watch out and address. Today, again, we have, as I said, first, we look forward to the Governor of Reserve Bank of India, who has been in this position from December 2018. And I think so many things have happened in his tenure of 1.5 years. Even to his session, which will be followed. The last session of the day will be economists who have agreed to come to our panel. who will be discussing and deliberating on how we can look at the various economic aspects. So at the outset, it gives me immense pleasure in welcoming the Honorable Governor of Reserve Bank, Sri Shaktikanta Das, and this session will be moderated by our Chairman. And I take pleasure in handing it over to him to take the morning forward. Thank you very much.
Do I speak now? Yeah. Thank you. Thank you, Mr. Arijit Basu, for that introductory remark and the welcome address. Good morning, Mr. Rajneesh Kumar, and good morning to all participants. I hope my voice is audible. ये मेरा voice जरा उसको.
Yeah, good morning, sir, and welcome.
Yeah, good morning.
Yeah. I can hear you, sir.
Yeah, there is some problem in the sound. Let me just.
Some echo is there, sir. You will just.
Yeah, some echo. No, I should not be hearing my voice.
Yeah. Some echo is there.
Yeah, no, there was some echo was coming, so they are trying to correct the technology. Okay, a very warm good morning to all of you. I wish to thank the State Bank of India for having invited me to deliver the keynote address today. I did manage to listen to one of the sessions which you had last evening. Very productive and useful discussions. The Chairman SBI and other eminent participants, I had the occasion to watch that. I sincerely appreciate the efforts of the organizing team in putting together this virtual conference, which has in fact become the new normal today. Banks and other financial entities are today at the forefront of the country's countermeasures against the economic impact of COVID-19. They are the transmission channels for RBI's monetary, regulatory, and other policy measures. They are also the implementation vehicles for the financial backstop measures announced by the government. I should not hear my voice. You can. No, but I am hearing my voice. Okay. I hope my voice is clear to the participants. Mr. Rajneesh Kumar, am I audible? Am I clear enough?
Yes, sir. Yes, sir.
Okay, thank you. Now, the outbreak of COVID-19 pandemic is unambiguously the worst health and economic crisis in the last 100 years during peacetime, with unprecedented negative consequences for output, jobs, and well-being. It has dented the existing world order, global value chains, labor and capital movements across the globe, and needless to say, the socio-economic conditions of large sections of the world population. The COVID-19 pandemic perhaps represents so far the biggest test of robustness and resilience of our economic and financial system. In the extraordinary circumstances that we face today, history could provide us with some useful guidance in respect of the role of central banks. Guided by the age-old wisdom summarized in Bajort's dictum that ascribes the role of the lender of the last resort to the central bank, the Reserve Bank of India has taken a number of important historic measures to protect our financial system and support the real economy in the current crisis. While the eventual success of our policy responses will be known only after some time, they appear to have worked so far. And that gives us a lot of satisfaction, and that inspires us also to take further measures. While reiterating our intent and dedication to steer the economy through the crisis, I would like to highlight certain key aspects of our policy measures. So what I propose to do is to sort of very briefly highlight some of the measures that we have taken, some of the approaches, our broad approach during the current crisis, and with special reference to the aspect of financial stability. Because as you know, the central bank, while looking after aspects of reviving growth, supporting the measures being taken by the government in terms of carrying out necessary changes and announcing necessary measures in areas that are in the domain of the Reserve Bank. But at the same time, above all, the Reserve Bank is responsible for the financial stability of the country. And this is one area where I think the Reserve Bank and the financial institutions, and in particular the banks will have to work in close coordination and in close cooperation to ensure the stability of the financial system in the country. Now, let me first briefly touch upon the monetary policy measures which we have taken. As you would be already aware, the RBI was already in an accommodative stance before the outbreak of COVID-19. And from February 2019 onwards, on cumulative basis, we had cut the repo rate by 135 basis points till the onset of the COVID-19. Now, consistent, and that was done mainly to sort of to tackle the slowdown in growth, which was visible at that time, and we had elaborately touched upon it in our MPC resolutions. Now, consistent with this policy stance, when liquidity conditions, we had also kept them in ample surplus. The lagged impact of these measures was about to propel a cyclical turnaround in economic activity when COVID-19 brought with it calamitous misery, endangering both lives and livelihood of people. Given the uncertainty regarding the evolution of COVID curve, it was absolutely critical to anticipate the emerging economic risks and take proactive monetary policy actions of sizable magnitude using comprehensive range of policy instruments. The fast-changing macroeconomic environment and the deteriorating outlook for growth necessitated off-cycle meetings of the Monetary Policy Committee, first in March and then again in May 2020. The MPC has decided, as you would be aware, to cumulatively cut the policy repo rate by 115 basis points. So from February 2019, the total rate cut that RBI has undertaken is 250 basis points. Now, we also focused on liquidity measures. I would not like to go into the details of that. They're already in the public domain. They're known to you. But I would like to just say that both conventional and unconventional monetary and liquidity measures by the Reserve Bank were undertaken, and they were aimed at, number one, restoring market confidence, number two, alleviating liquidity stress, number three, easing financial conditions, number five, unfreezing credit markets, and number six, augmenting the flow of financial resources to those in need for productive purposes. The broader objective was to mitigate the risks to growth outlook while preserving financial stability. The liquidity measures announced by the RBI since February 2020 aggregate to about rupees 9.57 lakh crore, which is equivalent to 4.7% of 2019-20 nominal GDP. So about 4.7% of the GDP. That is the kind of liquidity measures which we have announced from February this year. Now, heading into the pandemic, the financial system of the country was in a much improved position, owing mainly to the various regulatory and supervisory initiatives which the Reserve Bank had undertaken. We had put in place a framework for resolution of stressed assets, the 7th June circular, and the various other measures that Reserve Bank had undertaken, in addition to implementing multiple measures to strengthen credit discipline and to reduce credit concentration. For 5 years between 2015-16 to 2019-20, the government had infused a total of rupees 3,08,000 crore in public sector banks. As a result of efforts by both Reserve Bank and the Government of India, the overhang of stressed assets in the banking system had declined and capital position has considerably improved. As per available numbers, some of which are provisional at this point of time, the overall capital adequacy ratio of scheduled commercial banks stood at 14.8% in March 2020 compared to 14.3% in March 2019. The CRAR of public sector banks had also improved from 12.2% in March 19 to 13% in March 20. The gross NPA ratio and the net NPA ratio of the scheduled commercial banks stood at 8.3% and 2.9% in March 2020, which is basically a kind of a marginal improvement over 9.1% gross NPA and 3.7% net NPA as on March 19. The provision coverage ratio had also improved from 60.5% in March 19 to 65.4% in March 20. The gross NPA of the NBFCs, on the other hand, they had stood at 6.4% and that was the gross NPA was 6.4% and the net NPA was 3.2%. There was a slight marginal deterioration because, as you know, post IL&FS, there was a big impact on the NBFC sector. But notwithstanding that, we were constantly engaged with the NBFCs. So therefore, there was marginal deterioration. Similarly, their CRAR, the aggregate CRAR of the NBFC sector also marginally declined from 20.1% to 19.6% during 1920. What is important to notice here is that when the IL&FS crisis hit the economy, there were apprehensions that the damage to the NBFC sector could be even more. But because of the measures which Reserve Bank undertook, I have mentioned it earlier that we were constantly engaged with, we were very closely monitoring 50 top NBFCs, and thereafter we started monitoring totally 100 NBFCs. And we had ensured that from June of 2019, the system liquidity was adequately surplus. So all these helped the situation. Now, an important objective of Reserve Bank Supervisory Initiative, let me just highlight a little bit on what we are doing currently under supervision, because in a crisis like COVID, when there is a big challenge to financial stability, now growth is definitely important. That is one of topmost priority for the Reserve Bank. At the same time, equal priority has to be given, or perhaps greater priority, I would say equal priority. Let me not sort of try to say this is more important and this is less important, but equal priority has to be given to the aspect of financial stability. So therefore, the supervision mechanism of RBI also has been receiving close attention. The important objective of RBI Supervisory Initiative has been to put in place systems and structures to identify, assess, and proactively mitigate or manage the vulnerabilities among the financial institutions. During the last 1 year, based on assessment of events which had the potential to pose a threat to financial stability, the Reserve Bank has in fact reorganized its supervisory functions with an objective of establishing a holistic approach to regulation and supervision. These measures, they basically aim at effectively addressing the potential systemic risks that could arise due to possible supervisory or regulatory arbitrage and information asymmetry. Further, a calibrated approach has been designed to provide the required modularity and scalability to the supervision functions to ensure better focus on risky institutions and practices, and to enhance capability to conduct horizontal or thematic studies across supervisory entities. As a fulcrum of the calibrated supervisory approach, the Reserve Bank has strengthened its off-site surveillance mechanism. Now, this is very important. Internally, we have, based on technology, thanks to the the Acrylic system and the other technology tools that we have at our disposal, we have strengthened our internal off-site surveillance mechanism to identify emerging risks and assess the vulnerabilities across the supervised entities for timely action. We are also working towards strengthening the supervisory market intelligence capabilities of Reserve Bank with the help of both personal and technological intelligence. Specialized handling of weak institutions at the Reserve Bank now helps in closure monitoring and successful resolution of such entities in a non-disruptive manner. The timely and successful resolution of the Yes Bank is an example. After exhausting all other options, all other possible options, and with a view to safeguard the interest of depositors and ensure stability of the financial system, we decided to intervene at an appropriate time when the net worth of the bank, that is Yes Bank, was still positive. The Yes Bank reconstruction scheme forged a unique public-private partnership between leading financial entities of India, and it was implemented in very quick time, which helped the bank's revival, successfully safeguarded the interest of the depositors, and ensured financial stability. I wish to, at this point of time, compliment the State Bank of India for providing leadership to this initiative. With regard to the Punjab and Maharashtra Cooperative Bank, the Reserve Bank is engaged with all stakeholders to find a workable solution, as losses are very high, eroding deposits by more than 50%. With regard to NBFC's active engagement with stakeholders was found to be extremely useful. I have just mentioned about that. Now, considering their size and interconnectedness, the Reserve Bank has taken a number of measures which are already in the public domain, so I don't want to elaborate on that. But in the case of UCBs, let me just touch upon a few points. Special efforts are being made towards a risk-based and proactive supervisory approach to identify weaknesses in their operations as early as possible. At an early warning system with a stress testing framework has also been formed for timely recognition of weak banks for appropriate action. Formation of an umbrella organization has also been approved. The exposure limits of UCBs have also been brought down, and priority sector targets have also been revised substantially to ensure that the UCBs lend specifically and more to the sectors for which the UCBs, the urban cooperative banks, have been formed and for which they are operating. The recent amendments to the Reserve Bank of India Act and the Banking Regulation Act will facilitate RBI's supervision process with respect to NBFCs and the urban cooperative banks respectively. Now, let me just come to the aspect of RBI's response to the pandemic. As part of response to the pandemic, the RBI has undertaken a series of measures which are already in public domain, as I have already said. Besides, Reserve Bank's focus was also to ensure that contingency response to COVID-19 was implemented by all regulated entities swiftly. Now, as early as 16th March, in fact, when COVID was just about setting into India, we had written to all banks and other supervised entities, financial institutions which are regulated by the RBI. We had written to them to prepare their business continuity plans and to have mechanisms and measures in place to deal with the emerging challenges. All entities were advised, all entities including banks were advised to assess the impact of COVID-19 on their balance sheet, asset quality, and liquidity, and take immediate contingency measures to manage their risks. And that we did in March 16th. Now, as the lockdown has obstructed our on-site supervisory examination to an extent, we are further enhancing our off-site surveillance mechanism. And the objective of the off-site surveillance mechanism is to smell the distress, if any, and be able to initiate preemptive actions. This requires use of market intelligence inputs on an ongoing engagements with financial institutions on possible or potential vulnerabilities. The off-site assessment work, which takes into account macro and micro variables, is more analytical and forward-looking and aimed at identifying vulnerable sectors, borrowers, as well as supervised entities. While multi-pronged approach adopted by the Reserve Bank has provided a cushion from the immediate impact of the pandemic on banks, the medium-term outlook is uncertain and depends on COVID-19 curve. Policy action for the medium term would require a careful assessment, and this is very important. Policy action for medium term would require a careful assessment of how the crisis unfolds, building buffers and raising capital. I repeat, building buffers and raising capital will be very crucial, not only to ensure credit flow, but also to build resilience in the financial system. We have very recently, that is on 19th June and again on 1st July, advised all banks and NBFCs to sort of analyze and do COVID stress test and analyze the impact of COVID-19 on their balance sheet, asset quality, liquidity, profitability, and capital adequacy for the financial year 2020 2020-21 and also for the next year. Based on the outcome of such stress testing, banks and non-banking financial companies have been advised to work out possible mitigating measures, including capital planning, capital raising, and contingency liquidity planning, among others. The idea is to ensure continued credit supply to different sectors of the economy and maintain financial stability. So essentially what we are saying is that every financial institution, and in particular the banks, they have to do a COVID stress test, and I'm aware that many of the banks have already initiated this exercise, and each bank is expected to undertake this COVID stress test, identify what kind of vulnerabilities they have, what kind of challenges they are likely to encounter, identify the vulnerable points, and raise capital in time. I think that is very crucial at the moment, and that is something which the banks are expected to give topmost priority, and I'm aware that many banks have already started this process. Now, going forward, there are certain stress points in the financial system which would require constant regulatory and policy attention to mitigate the risks. It is not just regulatory and policy monitoring, or it's not only sufficient that the RBI is vigilant and watchful. It is equally or perhaps more important that the banks and other financial institutions are even more watchful of the emerging vulnerabilities and the challenges. The economic impact of the pandemic due to lockdown and anticipated post-lockdown compression in economic growth may result in higher non-performing assets and capital erosion of the banks. A recapitalization plan for public sector banks and private sector banks has therefore become absolutely necessary. While NBFC sector as a whole may still look resilient, the redemption pressure on NBFCs and mutual funds also need close monitoring. Increasing share of bank lending to NBFCs and the continuing crunch in market-based financing faced by NBFCs and HFCs also needs to be watched very carefully. Now, while I said that, the key takeaway here is not just that there is possibility of increasing vulnerability or that there is possibility of rising NPAs. That is something which is evident, it is obvious. When a natural calamity happens, when there is flood, when there is cyclone, when there is disruption due to natural calamity or other such incidents, naturally the repayment activity, the repayment behavior or the repayment capacity of certain borrowers get impacted, and that does impact the NPA position of banks. So in a situation like COVID-19, naturally there will be some consequences for the NPA position of the banks. But what I would like to emphasize here is that this is not really the key takeaway. This is obvious. The key takeaway from what I am saying is how we as a system, how the banks and other financial entities deal with this challenge, how they respond to this challenge. In such situations, as I have already said, I think it's become a lot more important that the banks will have to improve their governance, the banks will have to sharpen their risk management skills, and the banks will have to raise capital in an anticipatory basis instead of waiting for a situation to arise in advance, and proactively it is necessary. Banks, both public sector and private sector banks, build up adequate capital buffers. So this is the takeaway. The key takeaway is not that there could be rise in NPA. The key takeaway is how the banks are responding. The key takeaway is the need, as I said, to focus more on governance, focus more on risk management, and focus more on raising capital and building up buffers. The global financial crisis of 2008 and 9 and the COVID-19 pandemic have in fact dispelled the notion that tail risks to the financial system will materialize only rarely. The probability disruption of risk events has much fatter tails than we think. Shocks to the financial system, dubbed as once-in-a-lifetime events, seem to be more frequent and even more frequent than once in a decade. Accordingly, the minimum capital requirements, and this is again I am reiterating this point because of its importance. Accordingly, the minimum capital requirement of banks which are calibrated based on historical loss events may no longer be considered sufficient enough to absorb the losses. Meeting the minimum capital requirement is a necessary but not a sufficient condition for financial stability. Hence, it is imperative that the approach to risk management in banks should be in tune with the realization of more frequent, varied, and bigger risk events than in the past. Banks have to remember the old saying that care and diligence bring luck. To paraphrase Oscar Wilde, being caught unprepared in the face of a shock may be regarded as a misfortune, but to be caught unawares more than once may be a sign of carelessness. Now, I'm just sounding this, and I'm quite sure that the banks, especially our very close interaction with the banks, NBFCs, and other financial entities, based on that, I can say with confidence that our banking system, our financial system, is capable of rising to the occasion and meeting this challenge of ensuring credit flow and at the same time ensuring the robustness of their balance sheets. Notwithstanding the numerous steps already taken, there is always room for improvement to address several issues that may emerge in the medium to long term. These issues are common to NBFCs and other financial intermediaries as they are to the banks. The supervisory approach of the Reserve Bank is to further strengthen its focus on developing financial institutions' ability to identify and undertake measures to mitigate the risks. To strengthen the internal defenses, higher emphasis is now being given on causes of weaknesses than on symptoms. We are engaged constantly with the banks, and we are sort of trying to ensure that the banks build up their own internal frameworks and arrangements to deal with this situation. We are placing special emphasis on assessment of business model, governance, and assurance functions. Supervised entities generally tend to focus more on business aspects, even to the detriment of governance aspects and assurance functions. This is noticed sometimes. I mean, there has been a lot of improvement in the recent years, but still we see this in certain entities, and that needs attention. Now, the thrust of our approach is to improve the risk compliance, the governance culture of the financial institutions. In this regard, the Reserve Bank has recently released a discussion paper on governance in commercial banks with the objective to align the current regulatory framework with global best practices while being mindful of the context of the domestic financial system. The main emphasis of the discussion paper is to encourage separation of ownership from management. While the owners focus more on return on their investment, the management should focus more on protecting the interest of all stakeholders. The board, on its part, should provide overall direction and should build up the organizational culture and the value system in the country, and should put in place a broad framework for risk management and risk mitigation. And going forward, the Reserve Bank proposes to extend these principles of good governance to the large-sized NBFCs in due course. Now, I would like to conclude by talking briefly about the way forward. Now, despite substantial impact of the pandemic in our daily lives, the financial system of the country, including all payment systems and financial markets, are functioning without any hindrance. The Indian economy has started showing signs of getting back to normalcy in response to the staggered easing of restrictions. It is, however, still uncertain when the supply chains will be restored fully, how long will it take for demand conditions to normalize, and what kind of durable effects the pandemic will leave behind on our potential growth. Targeted and comprehensive reform measures already announced by the government should help in supporting the country's potential growth. Possibly in a vastly different post-COVID environment, reallocation of factors of production within the economy and innovative ways of expanding economic activity could lead to some rebalancing and emergence of new growth drivers. The policy measures, that is monetary, fiscal, regulatory and structural reforms provide the enabling conditions for a speedier recovery in the economic activity while minimizing the near-term disruptions. The need of the hour is to restore confidence, preserve financial stability, revive growth, and recover stronger. At the central bank, we strive to maintain the balance between preserving financial stability, maintaining the banking system's soundness, and sustaining economic activity. Post-containment of COVID-19, a very careful trajectory has to be followed in orderly unwinding of counter-cyclical regulatory measures. And please note this point very carefully. I am saying post-containment of COVID-19. So there is no need to assume that we are going to initiate withdrawal of the measures or rolling back of the measures that we have announced. That's not what I am indicating. I am saying post-containment of COVID-19, a very careful trajectory has to be followed in orderly unwinding of counter-cyclical regulatory measures, and the financial sector should return to normal functioning without relying on the regulatory relaxations as the new norm. The Reserve Bank is making continuous assessment of the changing trajectory of financial stability risks and upgrading its own supervisory framework to ensure that financial stability is preserved. Banks and financial intermediaries have to be ever vigilant and substantially upgrade their capabilities with respect to, as I have already said, governance, assurance functions, and risk culture. It's true that the pandemic poses a challenge of epic proportions. However, human grit, manifesting through collective efforts, intelligent choices, and innovation, will tremendously help us to come out of the present crisis. Mahatma Gandhi had said, "The future depends on what you do today." I have presented a bird's eye view of the resolutions that the Reserve Bank has taken currently to combat this unprecedented situation. I am confident that these will complement the measures undertaken by the government in achieving our policy objectives. Along with tireless efforts of thousands of people and the undying spirit of our populace, I am optimistic that these policy actions will yield the desired results. These are trying times, and these trying times will only strengthen world's faith in the resilience of our economy. We shall prove this together. Thank you. Over to you, Mr. Rajneesh Kumar. Thank you. Thank you very much.
Very much, sir. This was an excellent speech, and
Volume.
And sir, really, am I audible, sir?
Yes, you are audible. Okay.
Look, what I have observed since the beginning of this COVID, that the response of Reserve Bank of India has been very proactive, and timely policy interventions have happened, and many new measures which we had not heard of, like long-term repo. So this was an innovation, and it helped. There is ample liquidity in the system, which Reserve Bank has ensured. And there are, sir, a couple of questions some of the people have raised. With your permission, I may raise a few questions, and we are
Able?
Yeah, yes, sir. Please kindly, if you could repeat, sir. Yeah. No, sir, no. Mic unmute करो, sir. सर को और मेरा दोनों unmute रहो.
Is it okay now? Do you hear me?
Yes, sir. Yes, sir. It's okay, sir.
Yeah. I'll be happy to take as many questions as possible, depending on how much time, because your next session also has to start. So I'll be quite happy to answer a few questions.
Yes, sir. Yes, sir. But like time is not a constraint, sir. We don't get such opportunity, and all eyes in the country today are on Reserve Bank of India. So one is, sir, is it is becoming very clear, and yesterday Roderick Danny, he also very categorically stated that there is likely to be a new world order which will emerge. And India, of course, it also came out very clearly that we are not a major player as far as global supply chains are concerned or global value chains are concerned. So when we are moving into a scenario where the globalization in the current form uh, itself has become doubtful. Now, how can India find its place? We have been missing it. There were opportunities to be part of the global value chains. Somehow, India could not be part of those chains in a significant manner. So, should India now very seriously try to be part of those global value chains?
Definitely. In fact, I think at this point of time, the emphasis in India, as I have already mentioned, that the focus should be on correcting and undertaking certain measures with regard to land, labor, and other areas, and ease of doing business. And one thing that you will notice that I think Indian companies and Indian industry responds better in a crisis. You see how our pharmaceutical sector has responded to the current crisis and to the requirement of various medicines for which there is a great demand across countries. The pharma sector has remained fully functional even during the period of lockdown, and they have met the requirement. So there are lots of emerging opportunities, available opportunities world over. So with greater focus on ease of doing business, with efforts to sort of improve efficiency and productivity, this is a great opportunity for Indian companies to get into global value chains. But very important to become a part of the global value chain is to improve your quality of the product. I think that is one area sometimes we find. We don't find symmetry across sectors. Certain sectors the quality is ensured. Certain sectors are not able to break through into the global value chain because of quality issues. And this is one area where I think the large corporates have a major role to interact with their suppliers, the MSMEs and other units which supply them the various components and raw materials, or even the MSMEs which undertake product manufacture of finished products. I think the emphasis will have to be on product quality. This is an opportunity available, and I think we should capitalize it. There is potential. The emphasis will have to be on ease of doing business, on improving productivity, and in improving quality.
Thank you so much, sir. Sir, another question, sir. You talked about Yes Bank, and that is an example which brought out very clearly that if any financial institution, if it is facing situation or trouble, the existing Basel framework around liquidity and capital, it doesn't come much to help, because by nature all financial institutions are highly leveraged, and that's how we make our money, through leveraging. So in such a scenario, the a corporation or a resolution corporation who can provide both the equity capital and as well as liquidity, which otherwise falls upon either Reserve Bank of India or on any other bank like State Bank of India to give the equity and liquidity support. Is there any thinking, sir, where resolution corporation could be set up by Reserve Bank of India?
I think this is something which, as you are aware, this was part of the intention of setting up a resolution corporation was earlier a part of the FRDI bill, which the government withdrew because there were certain issues which needed closer examination. So therefore, the government withdrew that FRBM bill. But coming to the main issue, that yes, we certainly need a structured mechanism with legal backing to deal with stressed assets. I think that is something which is necessary. But I must say that the amendment and the notification, not amendment, but the notification issued under Section 227 of the Insolvency and Bankruptcy Code, I think that has given additional powers to Reserve Bank to deal with the NBFC and the housing finance sector. And under that, by using the powers which have been given to the RBI, the Reserve Bank has appointed, we have appointed an administrator in the DHFL, and that has now been referred to the NCLT, and the resolution of the DHFL, it is on stream now. I think that is going on fairly well. We review it, we do monitor it from time to time. But so far as the banks and other financial institutions are concerned, I think the approach traditionally has been, you merge a failed bank with a larger bank. Now, while that definitely protects the depositor's interest, but it also tends to pull down the balance sheet of the larger bank to which the smaller bank or the failed bank is merged. In the case of Yes Bank, we tried for a market-based resolution. There were investors who were showing interest, and we thought that is the best way of going about it, that new investors come in, put money, and take it forward. When that did not materialize, we then, without adversely impacting the balance sheet of any bank, any participating bank, we worked out this arrangement of public-private partnership, and we have had a lot of discussions during that period with you and your colleagues from the other banks, and a lot of consultations were held, and we came out with that mechanism. But going forward, I think we need legislative backing to have some kind of a resolution corporation which has to deal with resolution and revival of stressed financial firms. The regulator can issue early warning signals, can flag the emerging risks. The regulator will continue to take necessary measures, will continue to sort of interact with with the management of the bank or NBFCs to identify the vulnerabilities, but there has to be a legally backed arrangement. But having said that, as I have tried to explain in my in my intervention today in my opening remarks, and I must mention that a copy of this, whatever I spoke, a copy of my speech, the full text of which I did not read out, will be uploaded in the RBI website once this session is over. So those of you who are interested may have a look at it. But our primary focus is now to monitor it and identify the vulnerability from a very incipient stage, and then take corrective measures, impress upon the management, interact with the management, closely work with the management, ask them to take necessary corrective measures, whether some amount of governance changes or replacement of certain key personnel or mobilization of additional capital or additional liquidity. So our focus now is to identify the vulnerability from a very incipient stage and then engage with the management of a bank or management of a financial entity to ensure that the problem doesn't become larger. I think eventual solution lies in that. But having said that, I must say that a bigger responsibility lies with the banks and the financial entities themselves. And I'm quite happy to note that many banks in particular have, both in the public and private sector, they have improved their internal risk management systems and procedures, and they are able to take preemptive action. So the bigger responsibility lies with the management of the banks, and that is banks or the financial institutions. That is why we are focusing so much on risk management. That is why we have brought out this document on governance in commercial banks.
Yeah, very true, sir. And from your address today also, one thing which is coming out very clearly is that through governance, superior risk management, compliance, and capital buffer. So these are at least the four major pillars on which the banks and NBFCs can deal with the COVID-19 situation. Sir, one more question. there is an observation, and it's not a question. And the observation is that successive rate cuts do not appear to have spurred investment or growth, either pre-COVID or post-COVID, nor has it had any visible impact on better asset quality. Asset quality improvement is more attributable to better assessment and monitoring resolution mechanism at work. So the question whoever has raised is, they have requested if you could just uh, tell
No,
us your take on this.
the focus, as I said, is on asset quality, and here the bigger responsibility really lies on the banks themselves to closely watch and identify, to measure the asset quality and take whatever steps. So far as the Reserve Bank is concerned, in our supervision, we are also monitoring that, and we have been advising the banks to, wherever necessary, to make additional provisions. And there's a lot of new technology. I didn't want to talk about it. It would be a bit premature, but we are now focusing a lot on off-site surveillance, that is off-site surveillance by way of internal analysis based on a lot of data, new data, new systems of collecting data and analyzing data. We are relying more on, the data analytics and other aspects. So we are building up that robust mechanism to identify to sort of identify what kind of asset quality the banks have. But the bigger responsibility, as I said, lies with the banks, and this is one area where we are constantly engaged with the banks to ensure that the asset quality and the vulnerabilities are identified proactively so that timely mitigation measures are undertaken. Now, with regard to rate cut leading to investment, now the rate cut has several objectives. The rate cut, one, is to make money more accessible. But investment again depends on a complexity of factors. Investment again depends on the overall environment. If I can just quote one of my predecessors, he said, "You can take a horse to the water, but you can't make it drink." So essentially, to put it on a serious note, I would like to say that the observation made by my predecessor was definitely a serious remark. But what I am basically trying to say is that we are providing the enabling conditions for the economy to revive. We are ensuring that the rates are kept low. We are ensuring that the rates are kept low, keeping in mind the inflation trajectory, because maintaining the inflation is our primary objective. So as the inflation trajectory looks to go down, going forward, it is expected that the inflation will moderate. That's what we said in the last monetary policy statement. So we want to keep the inflation rates aligned with the inflation trajectory. We want to ensure that there is adequate liquidity in the system. We want to ensure that the bond markets and the financial markets are not, the liquidity doesn't get frozen, and there is adequate liquidity in the system, and the financial markets are functional. So if there is a corporate which wants to raise resources in the market, they should be able to raise it. In fact, if you look at the activity in the bond market and the number of number of corporate bonds which have been raised in the last 2 or 3 months, there has been substantial increase. So therefore, investment will it's dependent on a complexity of factors. At a time like this, naturally, corporates are deleveraging. The process of deleveraging is on. There's a slow revival of economic activity. Once economic activity revives, let us say, revives a little more, or perhaps revives even more than what it is at the moment, I'm sure investments will take place. The corporates will assess the market opportunities, and they will definitely, they should come forward and invest. And our emphasis is to provide enabling ecosystem where making investment or ensuring vibrancy and functioning of the markets in a robust manner. That is our emphasis. And I remain quite optimistic on these matters. It's a question of time, and I remain optimistic.
Thank you, sir. One final question before we close this session. To boost demand everyone is expecting that we can see more currency notes with your signatures. Are you going to oblige in near future?
I think the currency in circulation this year has increased significantly. World over, there is a rush for what they call a dash for cash. World over, in many countries, people are drawing more money from the banks and keeping it. The currency in circulation has increased in India substantially in the last 3-4 months because there is a tendency on the people to keep more cash. But with regard to your other question, that's a bigger issue on which we can have another discussion on another some other date.
Thank you, sir. Thank you so much. And really, it was a wonderful session. And all the participants who have registered in big number for this conclave, every year that number is increasing. And we had to do it in very unusual circumstances, but we didn't want to miss it. And on a Saturday, you have been able to address all the participants. We are really thankful to you, sir. Thank you very much.
Thank you.
As our chairman has said, thank you so much, sir, for the illuminating session. Yesterday, we had a scintillating discussion on the impact of COVID-19 on businesses, in which we had company heads brainstorming over the possible direction businesses could take in the aftermath of COVID-19. Today, the conversation aims to bring attention to the very pertinent question of what should be the focus, whether it should be lives or livelihood, and the complex interrelationship between them. For this discussion, we have with us Dr. Soumyakanti Ghosh, Group Chief Economic Advisor at SBI, Professor Ratin Roy, Director, NIPFP Delhi, Professor Rohini Pandey, Henry J. Hines, Second Professor of Economics and Director, Economic Growth Center at Yale University, Professor Sudipto Munle, Distinguished Fellow NCAER, Professor Shashwat Alok from ISB Hyderabad, and Professor Arjun Jaydev from Azim Premji University. Moderating this very erudite panel is CNBC TV 18's Executive Editor, Ms. Lata Venkatesh. Over to you, Ms. Lata.
So it's a very large topic, impact of COVID-19 on business and economy. And actually, it's a panel with many strengths. Soumyakanti Ghosh, Ratin Roy, and Sudipto Munle have written extensively on the impact, potential growth of the economy, on monetary and fiscal policy response to the impact of COVID. And then we have economists with some specific and unusual strengths, which we don't normally get to hear. Rohini Pandey is an expert on the impact on the informal sector. Essentially, women, and not necessarily only women, but the entire informal sector has done a lot of work on that. Professor Arjun Jaydev has done a lot of work on health, and Alok Shashwat has worked a lot on the impact of manufacturing, business itself, as a result of COVID and the policies taken. So we can have a many-sided discussion. We don't have to restrict it only to monetary and economic policy, but we have to certainly begin there. Actually, let me begin with a quote from Henry Ford. Economy has frequently nothing to do with the amount of money being spent, but with the wisdom used in spending it. So let's hope at the end of the discussion, we will be able to get some wisdom in how money may be spent. And of course, how do we find the money to bring the economy out of the rut? Let me start with you, Dr. Munle, not the least because you've been member of the Foreign Finance Commission, actually made policy and allocated resources. What is your best and worst estimate? Okay, we'll get to Munle in a minute. Why don't I start with the host? Soumyakanti Ghosh, what is your best and worst estimate of the extent of the hurt? We have all kinds of numbers flying. Many people are converging on -5, a contraction of 5%. Do you think it can get even worse? And when do you see the first quarter of the economy getting into positive numbers?
Yeah, thank you, Lata. I think we had actually already made our estimates earlier. The total, I think we are projecting a GDP contraction of around 6.8% in the current fiscal. And the problem is, however, that things are not as rosy as we had anticipated. Because if we look into our business disruption index, which basically gives a value of where we are right now, beginning from March onwards, if you normalize it, the numbers actually improved significantly in June, but towards the end of June, the numbers have dipped a little bit. It has started to increase again. But given the fact that many of the states are in lockdown mode, so I think there is a possibility that there could be an impact of growth. So this is one aspect. But on the other thing also, there has been a smart recovery in rural indicators in June. So which is a positive sign, because at least if that happens, one part of the economy will be insulated from the current pandemic crisis. But given the fact that things are uncertain as of now, I believe that there could be an extent of decline from the current levels. But it's too early to say as of now what could be the extent of such damage.
Okay. Ratin Roy, just to lay down the the terrain and therefore the extent and depth of the problem, what would your best guess be? Do you think at the moment we can even speak about one quarter, maybe 3 quarters down the line, fourth quarter down the line, when it looks like we may get back, pull ourselves by the bootstraps? What's your number? Are you looking at something, a contraction much worse than 5%?
I don't, as you know, Lata, I don't do quarters and I don't make predictions. And I'm not in a position to make a forecast simply because the global and national trajectory of this problem is yet to be understood and manifested to enable us, let alone us, any epidemiologist, to make any level of accurate projection. But it is certain that this economy of ours will be smaller, at least by the amount that, and I'm using the word certain, at least by the amount that Soumya projected. Because he is not projecting. If you read the SBI model, it actually uses real-time parametric data, which is not commonly used to forecast GDP to make a projection. And therefore, I would say that is the most analytically credible piece I've seen coming out from all forecasts. So since I don't forecast myself, I'll go with that.
Okay.
Now, I want to understand one thing though. It's important for your viewers to understand this. I don't quite understand how people project real GDP growth. Because GDP is calculated in nominal terms and then you deflate it to get real GDP growth. So unless we have a very accurate idea about what is happening to inflation, it is very difficult to say that growth will shrink by 5%. If there was deflation by 5%, would that mean real growth is zero? That's an unanswered question, and I'm looking for an answer from somebody someday.
Okay. We'll get into that. That gets into a slightly analytical and academic discussion. So we will.
It's very weird. It's not academic.
That as
it's common sense. You calculate
that. But basically,
in nominal terms, and then you get real. So how do you forecast real? This sensible thing. When you calculate GDP, you calculate it nominally in terms of the prices that are available to you, and then you get real. So I don't understand how these guys are getting real before doing the nominal. Okay.
All right. No, you have agreed that even in nominal terms, we may be seeing a contracting of the economy.
I simply don't know. That depends on inflation, and no one's giving me that.
Okay. Okay. Yeah, we have a problem even getting the data at the moment.
Yes.
And of course, there are too many unusual spikes. So there is a problem estimating. But, government and RBI have to make policy assuming that there is some extent of hurt. And that's why that was my first question to you. Ratin Roy, do you think the Reserve Bank is using its bullets correctly? And what more do you think they can do? They have tried to bring rates along with rate cuts and liquidity and also instruments like the TLTRO. Is there more scope to do this to ensure and encourage bankers to lend more?
Well, let me first say that I am not persuaded by the Reserve Bank of India's monetary policy statements, including that of the governor, regarding the rationale for these rate cuts. I heard him just before we started this session, and I continue not to be convinced. He is assuming, or is being told to assume, since he's not an economist by his economist advisors, that there is a linear relationship between a marginal reduction in interest rates, the inflation rate, and the growth rate, that operates through the price of capital getting lower and therefore people investing more. This assumption has been in place even before COVID. It is very clear that this assumption is not working in a simplistic way for some time now. Transmission is not happening, but there is an additional danger that as you lower interest rates below levels of 4 and 3 in our country, even if inflation stays at 3 or 4, you are getting into a situation where you may be entering the well-known J part of the interest rate curve, where further reductions in interest rate heading to at the limit to 0 or negative 0 have no impact whatsoever on policy. And you don't know when that comes. There is no theory that tells you when it comes. Theory tells you it does come. And I have seen absolutely no analysis from the Reserve Bank of India that tells me why we are not getting close to that. So my hope would have been that they would keep their firepower until such time as they knew that there would be a demand response for which investors would need to put money into working and fixed capital, and therefore there would be a rise in economic activity. What they have done on the credit side is to make credit available without collateral to some people. That's actually breaking your own regulations, hopefully for a noble purpose. I'd like to know what that noble purpose is. The noble purpose I can discern in it can only come from one place, given the lack of action in terms of direct income support by government. That the government has decided, either or, both these may be true, ideologically, that it is not its business to intervene in the economy. Margaret Thatcher would do that. Okay. It is the government's business is to help those who create wealth to intervene in the economy, and then what you do is you tweak the rules to help them create wealth, and ideologically you do reforms which shrink the state, which the government has announced. So if this government was a classic Thatcherite government, I would understand it claims it is not. Atmanirbhar and that sort of thing is not Thatcherite. The second thing would be if government has a profound distrust in its own civil service and its own mechanisms, and that would be good reason to distrust it in India, with respect to the delivery of goods and services. If you look at the quality of Narega delivery, the quality of education delivery, the quality of anything the government delivers, other than one-shot deliveries like Kumbh Mela, vaccination and elections, the record is poor. Maybe the politicians have understood that. And if the government is bad at delivering, then it does not make sense to provide income support. So for this, I can understand the logic of this package only from these two causal pillars. Thank you.
Okay. Well, Doctor, may I request you to look into the camera? You're looking a little left of the camera, and therefore perhaps the viewer will not get the benefit of it.
My camera is to my right.
Yeah, please look straight into the camera. That'll help. Well, actually, you're you've taken the conversation straight away into fiscal policy and what government should be doing. I will come back to you on what would you therefore want from the Reserve Bank, and also to whether further rate cuts should be either preserved for a later day, or whether they've already started reaching a point where a further rate cut may disincentivize saving so much that there isn't that it may actually be counterproductive. We'll come to the discussion, time permitting, but we have Dr. Woodall with us, the man who has advised on fiscal policy for a goodish bit. Dr. Woodall, do you think that what the government has done so far will help, at least in terms of survival? How would you assess the Atmanirbhar package or the so-called 20 lakh cross stimulus?
I am muted.
We can hear you, sir. We can hear you.
You can hear me?
Yes.
Okay. Yeah, let me then share screen with you to respond to the question that you just raised. See, here is the Atmanirbhar Bharat package. It has many things of a medium and long-term nature like reforms and so on. I am leaving those out and focusing on what is really the stimulus package. That amounts to about nearly 19 trillion. But of this, a lot of it is RBI liquidity injection, then credit guarantees measures under the program and so on. The fiscal component
is only about 2.6 trillion. It has been raised a little bit. There are a couple of things in July, like extending the food rations program, free food to November and so on. But it doesn't make a material difference in terms of the broad numbers. So the fiscal deficit only amounts to about 1.3% of GDP in that program. And this is what has led a lot of people to say the government has just not done enough. But the point is that this is only, if I may put it that way, a little bit of icing on the cake. The real fiscal stimulus is much bigger, and that is what I'm going to present to you now. You see, to calculate the total stimulus for this financial year, you first have to look at what was the central government's budget deficit in the budget. Then after that, and you can see that on the screen now, there were post-budget additional borrowings, all percentages of GDP. And then there's that fiscal component under Atmanirbhar Bharat of 1.3%. And don't forget that behind all, on the side of all this, there's also the states borrowing, which was 2.8% of GDP in their budget. And the additional headroom given to them alongside the Atmanirbhar Bharat program was about up to 2% of, close to 2% GDP. Actually, it was 2% of GSDP, but say 2% of GDP. So that total, depending on whether you count this extra headroom or not, comes to 9.7 to 11.7%. And this is actually a very substantial stimulus in my view, because it does not also include the off-budget borrowing of the central government or the state governments. If you were to add those into the picture, the PSBR, as you mentioned that concept, that is the budget plus off-budget borrowing, would come to nearly 13% of GDP. Now, this is all on the fiscal side. If you add to it what a very proactive central bank has been doing on its side, starting with, of course, the CRR, but many other things like the TLTRO and so on, all that works out. Plus, of course, the credit guarantee to induce lending, especially to medium, small, enterprises and NBFCs under the Atmanirbhar Bharat program, because you take away the risk by guaranteeing it, and then, in fact, there is quite some action beginning to happen on that front. So this adds up to another 8% of GDP. So nearly 12% of GDP as a fiscal stimulus plus 8% of GDP as a liquidity infusion monetary policy side. I think that is a huge amount of demand stimulation. And what will be the impact of this? For reasons that Rathin has elaborated at great length, I think forecasting is a technique that is, conventional forecasting is, sort of not permissible right now. But we do have to make assessments, and those can be based on scenarios. And that is what I'm presenting to you now in this slide. The first is a counterfactual scenario of what actually has happened in Q1, and for that it's not guessing, we actually have data on that now. And we at the NCR assumed about a 25% decline in GDP for the first quarter compared to the same period last year. And then with inflation and fiscal deficit, all that works out to and a current account deficit. Now that is, I say, counterfactual, because this assumes that stimulus that I just described earlier, the 11.7% GDP on the fiscal side plus 8% monetary side, has not been done. If you factor that in and assume that there are no supply constraints, you come to what I call the base case, and that you can see there, that row in red, which will actually take us into a positive GDP growth territory. But this is counterfactual, because it assumes that there are no supply constraints. There are actually very serious supply constraints. And all we can do in this situation, therefore, is assume, since we don't have data, and this is something Rathin was talking about, contrary to what people think, we in NCR have not been doing forecasting, but we have been scenario building. And we have looked at scenarios where the supply side constraints give us something like as low as minus 10% growth, to a very rapid supply constraint, which brings us something close to 0% growth. and looked at the possible inflation, fiscal deficit, and current account implications of that. My main takeaway from all this is not that the growth rate will be X or Y. You can ask me, I will give you my best guess. But the main point is that wherever we are on this, whether you look at inflation or the fiscal deficit or the current account deficit, in fact, current account deficit right now has gone into surplus. These may, be elevated, but they are not alarming. I mean, that is really the main point that I would like to suggest. Of course, there are risks of possible capital flight. If portfolio investors want to run away, they have been running away. But the good news on that front is that while portfolio investment is going, there's been a surge of FDI, which I was very pleasantly surprised to see recently. And that puts our balance of payments external situation in a comfortable place. So let me stop there.
Dr. Mondal, yeah, that has been a very comprehensive analysis of a survey of what has been done. But it also looks a little optimistic if you're saying that the fiscal stimulus is so huge. But the reality is that it has not reached a lot of vulnerable segments even now, precisely for the point that Ratan Roy is saying, the ability to deliver to the lowest common denominator. Rohini Pandey, if you can come on that, and thank you very much for staying up for this SBI conclave. I guess it's midnight for you, so thanks for that. But what is your sense about the action taken so far from a humanitarian angle? We always talk about macros and therefore, the money going from top down. But what about the bottom up?
Can you hear me? So thanks for having me on the panel. So let me start by saying I think it's a mistake to separate between the humanitarian and the fiscal. A key feature to recognize is that the COVID-19 induced recession is not the same as the 2008-2009 financial recession. And as many people would say, the first law of virus economics is that unless you manage to suppress or beat the virus, you're not going to fix the economy. So I think it's a huge mistake to be talking about fiscal packages or monetary policy without actually asking what is the likelihood that the virus itself is going to get suppressed, or what time is it going to get suppressed. We're seeing this very much in the US, that you can kind of come out of a big lockdown, go back into a lockdown. You can see states go circle in and out. So I think the first thing that is incredibly important is not to think of this as a regular recession or to talk about it as such. And so that brings me to, I think, the first point, which is to really look at health financing. I think it's very concerning that a lot of this discussion of the Atmanirbhar package or other packages is not talking at all about what investments are taking place in the health sector. How much are we spending on testing? How much are we spending on basic information campaigns to ensure people have information, and what do we know about what's happening there? So with that background, I think when we turn to what do we think is the impact of the various programs, yes, it's certainly the case that, partly because of lack of recent information on migrant flows in India, I think it was a huge surprise for everyone to recognize the extent of temporary or permanent return migration that has occurred as a result of this. So we've been tracking kind of sets of return migrants in North India, and you certainly see, when you ask them about their willingness or interest to return for employment, higher skilled and better paid migrants are willing to return. But I'd say the large swath of construction workers state that at least for the near future, they'd rather rely on NREGA than go back. So again, when we think about what's going to bring back the economy, if we're not thinking about the health concerns or the other concerns of these individuals, or how labor movements are going to happen, we're going to miss a lot of the picture. So again, I think separating out this humanitarian crisis from talking about economic recovery just isn't going to work. If you want to think about labor markets, you actually have to ask about what will bring someone back to a construction site. And right now, I think the answer is not enough is being done for that.
Okay.
And then I think, go ahead.
Rohini Pandey, therefore, how would you redesign? I mean, I take your point entirely that we were completely surprised by the number of migrants, the many millions of migrants, and their urgency to return, even if it meant walking several hundred kilometers. So our ignorance of large swathes of the economic problem was stunning. But how would you then design it? The ability to reach. So should the money be spent by lower and lower echelons of administration and not be centrally planned? How would you design the package, both for health and humanitarian purposes?
Thanks. So again, as I was saying, is that I think you have to think about what you're trying to target. So I think a lot of the discussion right now correctly is to talk about food insecurity or to say that we need to meet distress. The reason I'm trying to place it in the larger frame of saying that we need to think of this as very much part of economic recovery, investment in individuals and humanitarian, is first to make the argument you need to spend a lot more. So I think it's not just about implementation. I think the first order effect is to recognize that relative to other similar sized countries, India has both historically spent ridiculously low amounts in the health sector, but is continuing to not increase it very much right now. And so I think the first thing to recognize is by recognizing that economic recovery, the humanitarian crisis, and the health crisis are all interlinked. You want to increase the amount you spend. And then second, certainly, I think different states have invested in different social programs. So a one-size-fits-all isn't going to help. You can, when you look at the data, for instance, on PMJDY accounts, very simply, states that had opened bank accounts earlier just have fewer PMJDY accounts. It's not that they necessarily have fewer bank accounts, they just have fewer PMJDY accounts. So if anything, there's some evidence that strong state capacity is linked with fewer PMJDY accounts because by 2014, a lot of people had already got accounts. So again, restricting forms of access to a single centrally preferred scheme rather than saying, use all accounts, use PMJDY, use Ujjwala, use Enriga accounts, you're going to reach a much larger set of people. So I think that's the first part of what you want to do. The second part is to think about how, to not rely on labor markets coming back very fast. So right now, I think that the two views are we'll provide food rations through PDS, and we're basically now tapering off the cash transfer programs. But if you look at the data, even if the PDS functions well, it's roughly 50% of a household's food that you can get through PDS. So there's one question of can it reach well, the other question is whether it's enough. And I think once you recognize that it's not enough, you want to give states a lot more freedom in how to spend the money, and then either give them the resources or let them build up deficits even more. I don't see any way out of it. And I think talking about people returning to work or to areas, it's not going to happen unless they feel lower levels of food distress. Exactly the reason that made them go back is not going to let them leave if they continue to feel food insecure.
No, the point is taken. Actually, Sudipta Mundal should be very happy because his 14th Finance Commission had anyway recommended a large amount of state share in the common resources. But what you're saying is allow even greater deficit financing by states so that they can undertake the humanitarian need of providing food and health. I agree with you.
Again, I would not call it the humanitarian need. I would call it the need for economic recovery is as much linked to providing this. So I think we make a mistake when we sort of separate out this from humanitarian, when, for instance, equally we talk about gender issues as being separate from the mainstream. I think we have to recognize this crisis is a health-induced crisis. You have to respond to that in order to respond to the economy.
No, I take your point. I mean, absolutely. They are a vital part of the economy and labor, both in terms of labor and providing food itself, since many of them are in the rural areas. Coming back to you in a minute, Rohini, let me get Arjun Jaidev into the discussion. Arjun, the government, even the taxpayer is tired. The tax returns that we saw for GST were abysmally low. In the month of June, we appear to have reached about 90,000 crore compared to an asking rate of 1.2 lakh crore on an average. But the previous 2 months were like, 30,000 crores. So if you took April, May, June, GST collections have been perhaps, less than 40% of what what has been assumed in the budget, and non-GST collections were 30% of what it was in this comparable period last year, 7% of the total budget expectations. The tax money is not there. So now one looks at deficit financing. So, my question to you is, yesterday Indonesia has announced the central bank directly buying bonds from the government. Has the time come in India that you have to look for more money, as Rohini is saying, for health expenditure and for economic expenditures, survival and stimulus expenditure, and therefore the Reserve Bank needs to do more, directly fund the government?
So thanks very much, Lata. My sense is, this is something that has been talked about a lot, and I think that for the reasons you point out, that if you do want to in the end undertake the kind of expenditures that you really do need to in this kind of scenario, you would have to think about bridging it by some sort of deficit financing of this of monetization that we've been thinking about. Now, the Indonesian case is very interesting because obviously they've managed to do it so far without what they call spooking the markets, right? I mean, that's the big concern that we were going to, that if you do this, you will stoke inflation and so on. So there are things that you may want to do along with something, if you're monetizing the deficit, some sort of commitment to where you're going to be using the resources. People on this panel have written about it before as well. I have as well. There are different ways in which you can do it so that you can, in some ways, commit to not really going back to this kind of thing again and again, because there is the possible danger, and with the supply side bottlenecks that people are talking about, that over the medium term or even the short to medium run, you might hit bottlenecks, and putting all this money out there may lead to some inflation. Not there right now. I think we could do it.
Okay. Well, actually, I was so excited by the Indonesian experiment that I brought this question in advance, but I will come back to it and pose it to Dr. Mundal and Shaumyo as well. But, I wanted to ask Shashwat a slightly different question. While we have to look at all echelons of economic, of the economy to provide support, health and rural folk, migrants, MSMEs, SMEs, all those packages have been designed, however effectively or ineffectively they are being implemented. Shashwat, do we also have to think of some stimulus on, more importantly, help for the very organized sector? I mean, for 4 months, if a large number of companies have no revenues and still have to keep plant and machinery running and labor on the books, even that somewhat healthy segment of the economy is tired. So at some point in time, do we have to think of tax incentives or subventions, interest rate subventions, in some form even help, say, the top 2,000 companies?
So, thank you, Lata, for that question. Absolutely. So the top 2,000 companies, when it comes to tax rate when it comes to government fiscal support, we try to leave them away because they are not the most vulnerable. But if you look at the liquidity positions right now, many of them have complained about it already, that they don't have enough, given the lockdown, to meet their labor expenses, to meet their production expenses. Now, the problem with this is, this can have a ratcheting effect. This is a temporary shock. On fundamentals, they are strong. They hope to remain profitable in future. But if they are not able to churn their wheels right now, the wheels will stop gradually. And to help them navigate this situation, at some point government needs to think about it. Now the problem is, everybody keeps asking government to spend more. Where do we have the fiscal space from? Unless we think about monetizing the fiscal deficit, I don't think that government can go and borrow from public sector banks, which is what historically we have been doing. If the government were to borrow these large amounts from public sector banks, it is going to crowd out private sector borrowing. And in any case, we know that private sector is not borrowing as much. So we are in a fix. I do believe that both the government, the finance ministry and the RBI are taking a close look at how the economy is progressing. And at some point in future, if things still are going south, we might have to provide some sort of support to even the bigger firms.
Okay, how do you get back animal spirits? I mean, while we do see the government and the Reserve Bank trying to provide help to several firms, no one's going out and spending. And as Rohini points out, the health crisis is the first thing that we have to tackle. We don't yet have a vaccine. The medicines are also, kind of not really there. So there is no confidence even when you open up cities to see people come and use a restaurant or use even shops. There is more of e-commerce than really going out. So how do you get back first consumer confidence and then the animal spirits for investment? Any ideas, Shashwat?
So my take on this is the following, right? You have to think about why people are not spending. One is, yes, there is issues with expectation of job loss and unemployment, so people want to save. If you look at Jan Dhan Yojana accounts, right, about 40,000 crores direct cash transfers have been made. But from the beginning of the lockdown to up until now, 15,000 crores is the increase in total deposits in this account in just this 2 months' time. Compared to last year, the increase in the entire year was 26,000 crores. So people are not spending, one, because they're uncertain about their future. Second, there is, even among the rich, there is fear of the COVID itself. And this is where I think Professor Rohini Pandey's comment is very, very important. Unless we have a vaccine, unless the government builds up health infrastructure, some visibility on when this situation is going to improve the health situation, only then will people, I think, would want to spend. So even if you do cash transfers right now, I don't think people are going to spend it. Look at the amount of loan guarantees and credit being made available to MSMEs. About 3 lakh crores have been sanctioned. Sorry, 1 lakh crore has been sanctioned about the 3 lakh crore provisioned. 40% of them has been dispersed. But there is a 60% gap which people have not yet borrowed, either because of implementation issues or because they are uncertain about the future. How do you get back animal spirits? I mean, that depends on whether the dominant concern is expectation of a liquidity shock continuing in future, or the dominant concern is the fear of the health shock. Many migrant labor may not want to return back to the cities, not just because they were not getting a good conducive environment to live, but they are bothered about their health infrastructure, their health condition as well. And these are the most vulnerable population. They can't just go to a big hospital and spend. I don't have any easy answer to how to get the animal spirits going, but this is a framework to think about it.
Yes, probably it's a slightly distant question as well, as both Rohini, you and everybody is pointing out. The health crisis has to be resolved first, but often you can't wait. I mean, the economy has to propel, because in India and in many places, of course, it is not just that the virus kills. The virus deaths are 20,000 perhaps at the moment in India, but poverty and lack of livelihood can kill even more. We are not counting the deaths due to TB or lack of attending to TB, lack of attending to malaria, by even death by malnutrition. We are not counting the other deaths. And therefore, we can't stop not stimulating the economy simply because we have also a big health crisis to handle. Rohini Pandey, a slightly longer term question to you on this. It is quite possible that now that the cities have far fewer migrants, the so-called organized and slightly better off economy, say India Inc., will actually go for greater automation. Would you worry that at the end of the crisis, as and when the epidemic also slows, we may actually see greater inequality, because the fruits of the industrial and the organized economy will be going to fewer people, and they will be even more marginalized in the rural areas?
Thanks, Lata. So let me just say one thing on your first comment is there are ways of, in effect, having, say, a Keynesian push of increasing demand that is actually responsive to the crisis. So you could, for instance, imagine having a lot of investment in creating a slightly trained health labor force that's doing things like thinking about contact tracing. India has a great record of having done things like contact tracing for polio. It does some for TB as well. So there's a significant amount of investment that we could be making in having expanding hugely frontline workers and also paying the ones that are there, Right now, what we have is we have a compounding of a small set of frontline workers, and they're actually not getting paid. So I think it's slightly false to say that the demand expansion or the push of the economy can't be responsive to the health. I think there's a way to make both of them go in line. Turning to your question of automation, I think it's not clear that there is a huge scope to put in the kind of financial investments needed for significant automation right now. So for exactly the reasons that we're talking about, for an industry to fully automate requires the type of investments that right now they don't have the money to do it. On the margin, some of the jobs that may go, for instance, if you say that we're going to have, rather than having manual scavenging, we actually use automation, that's not a bad thing to do at all. Yeah. So I think we need to be very clear in thinking about what we're talking about automation. There's a lot of areas where automation goes hand in hand.
I'm worried about, no, Dr. Pandey, I might as well tell you, I'm worried that the amount of jobs, for instance, that's available in the automobile industry or automobile parts, ancillaries, it's a very successful industry in India, almost world-beating in several things like two-wheelers. A large part of this, even construction actually. Nowadays, we have prefabricated bridges. There was a time when building a road or a bridge in Mumbai would mean, hordes of migrant labor coming in and getting a job and settling on into the city. Not so anymore. Mumbai has been crisscrossed with flyovers without a single migrant worker in the picture. A large amount of potential labor or labor generating jobs have now become, less labor generating.
I agree, but more. I agree, but I think the problem is that you're not talking about the majority of labor working there. So I think we look at cities at very specific sectors and think, oh my God, this is going to get automated. This is not the majority. If you look in the data, where are the majority of unskilled workers? The majority of unskilled workers are right now in areas that are quite far away from automation. And if you think about sectors that you're concerned about, let's say garment and textile industry in the south, the bigger immediate concern to me is not that it's going to automate. It's just that right now women are not going to return. The pipeline is leaky enough for this kind of return migrant to come. They've had a pretty bad experience. Their families are going to say get married. So I think it's a very it's imposing on India a worldview that we want to have, that, oh, maybe the Indian labor markets are the US labor markets or the Chinese labor markets and they will twist. It's not the case. We are much more unskilled. We are not so manufacturing driven. So it's not like automobiles is the large sector that is pulling in people. India is a service driven economy. Something like hotel workers are not going to get automated. Domestic workers are not going to get automated. I think the issue is much more they're not going to return. So I think you need to look a lot more in the data. The last thing I'd say is a lot of people have been concerned about potential pushing back of labor regulation as a way of increasing inequality. Now, obviously, that's not a great thing to happen. But again, when you look in the data, which we have, if you look at the latest PLFS data, for instance, 95% of textile workers are not on contracts. So they are anyway in the informal sector. They're not going to be affected by whether the regulation becomes easy or not. So we should certainly be concerned about labor regulation. But let's not kid ourselves that that's where the inequality is coming from. A lot of the inequality is coming from purely informal work. Workers right now prefer very often informal work because they can't afford to lose off a very low wage, a high fraction to tax. Right? So the average worker would rather go and work in Dhaga work in Gujarat, where you don't have to informal work, rather than being in some very fancy industry where 60% is held back as social security.
Okay. Then it's a problem. We don't have to worry about that. Greater automation in the already small manufacturing sector might create greater inequality. If that's not a problem to bother, I won't persist with that. But you have started off on the path of suggesting solutions. As you point out, greater expenditure on health can itself be a Keynesian way of kick-starting growth. If you have a larger number of health workers and you pay them, they generate their own demand, and that can be a stimulus, an ignition key for the economy to start, at least in some localized areas. That's a great idea. More money given to the states, more deficit financing powers for states, so that that also creates microeconomies where demand is stimulated. You've started off on giving us solutions, so let me use the last 15 minutes of this discussion to get more suggestions. Dr. Mundal, to you, what would you recommend as the next steps that both Reserve Bank and the government can take to ensure that both survival and stimulus are provided?
Thank you, Lata. First of all, I want to correct an impression that anybody may have got that some of us are very narrow fiscal or monetary economists who only look at that and not think of larger issues. You asked me a question about the fiscal package, and that's why I talked about it. In fact, most of my writing in the past few months has been precisely about what can be done in terms of ramping up our health facilities, in terms of providing more food support and providing more income support. And all this not as add-on sort of, welfare packages, but as very much as part of a macroeconomic strategy. So having clarified that, now let me come to the specific issue that you're asking. I think we can certainly, the government on this is the one thing the government has done pretty well. I think it's been ramping up the food distribution, but I think it should be universalized. You and I have talked about it before. You don't have to limit it to people with ration cards and so on. There are other administratively very simple ways of doing this. If there's time, I can go into it, but let me leave that aside. Secondly, provide universal, the UBI type of income support. I think this is a major lacuna in what the government has been doing on the Atmanirbhar. There's some mental block against this. Again, you can universalize this, and according to my calculation, something like 1,000 rupees per month per household would cost us about 2% of GDP on that alone. And then the need to ramp up the health services. You cannot produce qualified doctors and nurses overnight, but you can have low-skilled health workers to do many things which were mentioned on the testing side and contact tracing and so on, a number of other things. Certainly you can provide more equipment, you can open more hospital beds, all that's being done already, but probably you need to do it on a larger scale, and that would give you another 2% of, my estimate is what we can absorb today in terms of absorptive capacity on the delivery system side would be another 2% of GDP. And a very important point that was made both by you and by Rohini Pandey, the action is done by the states. The central government is only an enabling institution which will help in making the resources available, but the action has to be done in the states. So much more elbow room to the states, not just in terms of the amount of money, as you said, 14th Finance Commission, we try to do that, but in terms of freedom of action. Instead of laying down, detailed programs from the central government, you shall do this or you shall not do that for the health program or for food, this, whatever, leave it to the states. They have as much capacity as the central government, in all the central government bureaucrats and fellows who have come from the states. There's no difference between them. So I think is the way to go, of a much more decentralized decision making on what should be the relief arrangements, because what you need in Bihar may be different from what you need in Kerala. Let me stop there. Thank you.
Exactly. I was going to suggest that perhaps the Kerala model provides at least some, model for others to follow. But very quickly, Dr. Mundal, I didn't get your view on the Indonesian suggestion. I mean, at some point, we have to think of financing of the government's deficit as well. It will come definitely in the second half. That question will arise as the tax receipts fall further and further from the budgeted estimate.